Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. On tonight's show, St. Wong of Prime Value, the fund manager, he's looking at the kind of stocks that you might want to accumulate now for later down the track. He says he basically has acquired a lot of stocks during the sell-off period, but at the moment he sort of is waiting to pounce, but he has actually identified a number of interesting companies that you might be interested in considering yourself. And then we've got Shamgar, the fund manager from Tamman Asset Management, and he's interested in tech stocks, particularly EML Payments, a big fan of this particular company, and a number of other ones. He explains what kind of tech companies he likes in particular. Then poor Rickard and myself, we look at the healthcare sector and pinpoint the stocks that we think look like good value now, worth acquiring for the eventual comeback of the healthcare sector. That's the show. Let's kick off now with St. Wong of Prime Value. Joining me now is St. Wong from the Prime Value Fund. Great to see you, ST.
Morning, Pete.
So before I start talking about specific stocks, what's your feeling about how the overall market will work out over 2022? At the moment, clearly there's question marks and there's volatility, but what's your feeling across 2022?
Yeah, look, Pete, it's clear to us that, looking to the rest of 2022, we're going to see slow economic growth, greater risks, but we're still optimistic. And we think there's still a number of themes that is going to come across the market, which is worth investing in. And whilst we acknowledge secularly high interest rates is going to impact returns on the market, we think that the market is still, somewhat more pessimistic than what it should be, and so therefore looking for opportunities to invest into 2022.
Yeah. My feeling is this, ST. And they rest on two things that really, to me, aren't easy to guess as an economist or as a market player. One is, I think if the Ukraine war ends earlier than expected, the market will love that. Do you agree?
Absolutely, yes.
Yep. And the second one is if China gets on top of its lockdown and pandemic issues quicker than expected, and therefore we get more supply out of China and less supply chain problems. Both of those two things should help bring inflation down and even hose down the expectations that interest rates will be rising so quickly that it will really KO tech stocks and the market generally.
Sure. Look, Pete, as you know, what we're going through at the moment where inflation is concerned is, as you know, as an economist, the base effect. Right, we're cycling very low inflation numbers in the previous 12 months, and that will continue into the June quarter. Once we get past the June quarter, we'll see a normalization to some extent of the base effect, where the inflation numbers or how it's calculated is concerned. So really, from that perspective, the market should be looking through into, I guess, in a softening on the inflation numbers, on the headline numbers per se. What I'd add to that, Pete, and I agree with what you said so far, where China is concerned, is there really remains a growth cushion in the US, and especially as Northern Hemisphere summer approaches, we should see an even greater normalization of, a number of, day-to-day activities, which should see economic activity pick up. To the extent, I think the point that the market is kind of ignoring at this point and kind of forgotten about the fact is that the consumer drives the US economy largely, 60% of the US economy, and that part of the economy, the consumer, is in a really, really strong position. The wages are going up. The household balance sheet is in an absolute strong position. I think the market is failing to recognize that there is a base effect coming through on how inflation is calculated.
Yep.
We're cycling through a base effect coming through, and we will see that into the June quarter. But once we get past June quarter, we should see an easing of the headline inflation number from how the inflation rate is being calculated. The other point that the market is ignoring and failing to acknowledge is really the strength of the US consumer. There clearly remains a growth cushion in the US, and with the Northern Hemisphere summer approaching, we should see a resumption of many elements of normal day-to-day activities. The shift from goods to services that will kick the US economy along as summer approaches. What we're thinking from a consumer perspective, and is a key driver of the US economy, is that personal incomes in the US are at record highs and has really improved even over above where pre-COVID levels are concerned. And the household balance sheet is absolutely in an excellent position. So the ability of the US consumer to spend or to keep spending is actually really, really strong.
So, and that potentially underpins a stock market that could have a strong finish rolling into Christmas.
Yeah, I think so, Pete. I think the money really follows corporate profits, and to the extent corporate profits continue to grow, then the market should follow suit in that sense.
Okay. Let's come back to what you're actually doing in the market now. Have there been any recent acquisitions to your fund?
Pete, we haven't been doing a lot at this juncture. The market had a good run in March, so we've been riding on the back of that. But clearly, the pockets of value in the market, tech is potentially an area we might get into in next 3 to 6 months. But we do recognize that we're looking into slow economic growth into 2022, 2023. The risks are higher, and the market is somewhat more challenged because of that. So as a result, when we're looking for stocks, we're looking really for three things as we consider the investment proposition: cash flows, quality, and pricing power. And those are areas we're looking to fish into, so to speak. And these are areas we're looking to invest into as prices pull back quite substantially in some of the areas we're looking into.
Give us some names of classic companies that fit those three bills.
Great, Pete. Look, with bond yields rising, the tech sector is obviously a sector which we'll be considering. The companies that sort of fit the criteria we're looking for, which is cash flows, quality, companies such as REA and Zero fit into that perspective. We're probably still cautious on companies which are not making profits, just relying on revenue to support the share prices. So these are sort of companies where we think are going to be immune or less impacted if inflation do continue to be an issue for the market.
What's your position on mining companies? Because people keep asking me, well, BHP and Rio and Fortescue have done well, but can they keep on, even if, say, for example, the Ukraine war ends and energy and resource prices come off the boil, is there still going to be enough sufficient global demand for these sorts of products so their share prices will hold up?
I think you want to be pretty selective in the resource sector. If I pick energy, for example, oil prices, about $100. The key question, for example, is do we continue to buy stocks like Santos or Woodside? I probably think that in the short term, there's probably somewhat of a bubble where oil prices is concerned, as we discussed earlier. Should there be a resolution to the Russian-Ukraine situation, oil price might pull back. But it absolutely makes a brilliant entry point into stocks such as Santos and Woodside should that event occur. Because I think in the longer term, the fact that large oil and gas companies haven't been investing in oil projects because of ESG concerns, it makes absolute sense to enter into stocks such as Woodside and Santos because of the corporate structure that they do have. So you want to be quite selective in your entry points, but also on the sort of commodities that you're kind of looking into. Now, lithium, for example, has been the hottest commodity so far this year. I think lithium price went up about 80% so far this year. So you want to be quite selective as well as to the timing. Whilst we're quite positive on the lithium outlook on the lithium sector in the longer term, we do recognize that there's been a significant upshot in lithium prices, and you might want to wait for a pullback in lithium prices before considering some of the lithium stocks. The sort of lithium stocks that we do like are lithium companies which are actually producing or well on the way to producing lithium products. The likes of Mineral Resources or Allchem, for example, are probably the sort of companies or resources plays that we're really into.
Great stuff, mate. Thanks for joining us. You have a great Easter. We'll talk to you in the future.
Thanks, Pete. Happy Easter.
Well, there's some M&A players on at the moment, and one guy who wants to talk about it is Ron Shamgar from Tamman Asset Management. Ron, thanks for joining us.
Hey, Peter. Thank you for having me.
All right, now before we get into some M&A activity, what's your feeling about what the stock market can do over the course of 2022? I have a feeling that eventually, if the Ukraine war gets settled in some shape or form, and China comes out of lockdown, we start seeing more and more supply chain improvements, that the stock market could really like that and roar back. Is that too optimistic, do you think?
Yeah, look, I mean, possibly. I think really, yeah, I know there's a lot of issues out of China with their lockdowns, and then you've got Ukraine, Russia, but I think still the main reason for the market being down this year or quite volatile is the inflationary concerns and how much central banks will have to raise interest rates, and will they go, will they sort of, wait too long and then they'll have to go too hard too quick, which means we'll have quite a hard recession. So I think this is the biggest concern, and we saw the inflation numbers overnight. It was probably sort of in line with expectations, but maybe a little bit better. And the question is, does it start to sort of come down from here? Have we seen peak inflation, or does it get worse? So that's the big question.
Was this part of the reason, Ron, why I link Ukraine and China lockdown supply side problems? Because if those two things work out in the optimistic way, it takes a lot of pressure off inflation, doesn't it? Oil prices fall. In Australia, we've got the 22 cents a litre reduction for at least 6 months. So inflation will be, if inflation ends up being less worrying, then all the worries about interest rate rises being excessive, they could be peeled back. And then people like you who live and breathe stocks, you'd be saying, you little beauty, wouldn't you? We're off to the races.
Yes, I totally agree. I think, if those issues get resolved, then it would definitely help with inflation. So we'll have to, I guess, see what happens. But I still think there's opportunities in the market, and we're going to talk about M&A. But I think with the depressed valuations for some of these stocks out there, really good businesses that are growing, I think you're going to see more and more M&As. And we've seen this morning EML announced that they've been approached by private equity.
Yeah, and EML is one of the companies that I've been a big fan of, but I know they've had their problems, but I think essentially they're a pretty good business, but they've had some curveballs thrown at them from the Irish Central Bank and all that sort of thing. But it's interesting that private equity is sniffing around.
Yeah, definitely. Funnily enough, if interest rates are going to go higher, EML actually makes more profit because they benefit from a higher interest rate environment on the money that they hold. So it's actually a positive for them. Yeah. But yes, that would be interesting.
Have you ever held EML in your fund?
Yes. We've been big supporters of EML for many years now. We hold it. Yeah. And it's actually, funnily enough, it's the top 5 most shorted stock on the ASX.
Yeah, I noticed that, yeah. But I can see the big smile on your face talking about private equity sniffing around. Okay, let's go and look at some other companies. There's one involving Unity. Explain to my viewers what Unity does and who's sort of stalking them.
Yeah, sure. So look, Unity Group, really simple business. They're a private fiber owner and operator. So really the best way to explain them is they're mini NBN. So it's essentially like owning a high growth NBN. Basically a duopoly competing against the NBN. They've got a 20% market share of all the private fiber household connections. There's about 1.4 million connections out there. They've got about 20% of that. And now we estimate that they currently are winning about 40% of all the tenders with the property developers versus the NBN. So they're winning a higher share of their current market share, which means more growth in the future. Now, just to give you an idea, they'll make about $150 million of EBITDA this year. Now, it's a very defensive, strategic, long life annuity asset that's actually inflation proof as well. So very coveted asset. Now, it got a bid from Morrison & Crowe, Morrison, which is a New Zealand fund manager with Brookfield together, initially at $4.50. Then they got another bid at $5 from a Macquarie Bank consortium, which owns Vocus, and Morrison & Co. Matched that bid at $5. So we have a bid at $5 for this business, valuing Unity Group at about 22 times EV to EBITDA. Yeah. So we've seen some telco mobile towers being sold recently at up to 29 times EBITDA, and those are pretty much non-growth. So we think there's a bit more upside here, and I think you might start seeing some super funds emerge and look at such an asset like Unity Group, because they can hold that for 30 years for their super members, and they can still get a really good return out of it.
Yeah. I think Unity was kicked off by an ex-student of mine, Vaughan Bowen, I think, wasn't he?
Yes, Mick Simmons and Vaughan Bowen, a great management team. You know, they've done this before with M2 and Vocus, and looks like they're going to do it again.
Yeah, yeah. Well taught, mate, well taught. Let's go to Ardent Leisure.
Yeah, so that's another interesting takeover play at the moment. So last week, they got actually a sale of their main asset in the US. So basically, Ardent Leisure owns Dreamworld, a theme park in the Gold Coast. Everyone knows that. And they own Main Events in the US, which is basically like a family entertainment venue chain, with bowling alleys and so on. Now, Main Event was sold to one of their biggest competitors in the US called Dave & Buster for about $1.1 billion. Now, there's a complicated ownership structure there, but just to simplify it, they're going to end up with about $580 million of net cash and Dreamworld. So they'll return to investors 90 cents or 430 mil, and then they'll keep about 31 cents or 150 mil cash to support Dreamworld. They're looking to redevelop some of the land into a resort and some of their sort of growth capex for the business. So at $1.30, which is currently the share price, you're basically getting Dreamworld at a $60 million enterprise value. And this is a business that pre-COVID and pre that accident that they've had made $30 million in EBITDA. So these assets can go for at least 10 times. So essentially, this Dreamworld could be worth a lot more, maybe up to $1.80 best case scenario in terms of some of the parts. So it's another interesting play. I think if you can get it under $1.30, I think it's not a bad play.
Yeah. So you're saying at this point in time, Ardent Leisure looks like a buy.
Under $1.30, I think the risk reward is quite attractive.
Yeah. Okay. Now, Clearview. Tell us about the Clearview story.
Yeah, sure. So these ones are not under takeover yet, but we believe that they will be taken over soon. Now, Clearview is probably quite an imminent takeover deal. They're essentially the largest remaining independent life insurer in Australia. They've got about 7% market share. Now, the industry consolidated in the last few years. The banks basically exited, and they all sold to the Japanese life insurers here. Now, Crescent Private Equity, they hold about 45% of Clearview, and they've announced in October last year that they're exiting, and they are doing a strategic review. And we believe that this will finalize in the next few weeks, and a takeover bid will emerge. Now, the current embedded value of Clearview is about 97 cents. Now, embedded value is essentially the future cash flows of all the policies that Clearview holds, discounted back to today. So if you just liquidated everything and you just collected the cash off these policies, you would get 97 cents or potentially more. So the shares are trading at about 75 cents. So there's good upside there. And historically, transactions in this space have been done on 1.1 times that EV. So potentially, with a bit of luck, you can get over $1 bid in the near term. Now, the industry is back to a really good profitability. It had some issues in the past, but things are going well. And funnily enough, rising interest rates again, they add to their profits because they hold a float of those premiums and they invest that. So every 1% interest rate adds about 10 to 15% to their profit. So we think there's about 30 to 40% upside here in the next 4 to 6 weeks. We expect this strategic review to finalize.
Who would be the kind of, what kind of businesses do you think would be interested in picking up Clearview? Will it be a financial institution, a big insurer, or private equity?
Yeah, we think, look, it would be, because it's only 7% market share, it's small enough not to cause any competition concerns. So the other Japanese life insurers in the market, they could just still acquire it. And it's sort of strategic enough for someone to enter the sector at the perfect time. And then private equity could also buy it as well, and they could take a lot of cost out of the business. So I think there's a few potential outcomes there. And, I guess we'll just have to watch over the next few weeks and see what comes out of this.
Okay. Now, finally, Sigma Healthcare.
Yeah, so that's another one that we like. It's a top 2 player in pharmacy and pharmaceutical distribution in Australia. Now, their competitor, Australian Pharmaceutical Industries, which owns Priceline, that was just acquired by Wesfarmers, and after quite a takeover battle with Woolies. Now, Sigma has actually spent in the last 4 years about $350 million in CapEx on building the latest distribution center network in Australia, which will give them significant savings and profits in the next few years. Now, that CapEx has essentially come to an end. So they should spit out a lot of free cash in the next few years. Now, they recently did have issues with implementing a new ERP system, and it always causes problems for companies. In fact, API had the same issue a few years ago when they did that. But that should sort itself out, which is part of the reason why the share price is depressed. But this is a business that should be making, in about a year or so, close to $100 million in EBITDA. And now if you look at API, that was bought on about 8.5 times EBITDA, and which will value Sigma at around 75 cents, which compares to 48 cents today. Now, we think that either Wesfarmers will bid for it. They said that API is just the first acquisition, to build up this health and beauty division that they want. We could see Woolies come back and have a go. And then what's interesting, there's another player in the market called DHL. They're a German-listed, huge, distribution business. Now, they won the Chemist Warehouse contract off Sigma a year ago. Wow. They couldn't service it. They had to literally give it back to Sigma because they couldn't service it profitably. This shows you the sort of competitive moat in the distribution network that Sigma has. And I think the Germans are quite proud people, and I wouldn't be surprised if they buy Sigma just because of that fact. So I think it's an interesting one.
It's the first time I've anyone heard use pride as a reason for investing, but I'm happy to run with it. Happy to run with it, Ron. Before we wrap up, mate, you mentioned EML earlier. Payments companies have really copped it. They've copped it basically twofold. One, because they're tech companies, and B, because they're in the payment space. You look at the list of short sellers, and I think EML, Tyro, Zip, they're all on the short list. Do you think that the market has overreacted in marking those sorts of companies down, and eventually when there's a re-rotation back into tech, that these payment companies also will get an uplift to a more acceptable price as opposed to the current prices?
Yeah, look, I think yes and no. So there's no doubt that just valuation multiples have come down in the entire technology, payments, whatever sector. So that's one factor. But I think, the ASX investors, I don't think they really understand payments businesses. So EML is a true payments business, and there's not many like it on the ASX. And, yes, it had some issues, but those are, behind it. And like I keep saying, every 1% interest rate rise around the world adds at least $50 million to EML's bottom line. There's not many companies that can say that. So they're actually a beneficiary but the market doesn't understand it yet. Now, the buy now, pay later companies like the Zips and the Afterpays of the world, they're not payments companies. They are short-term consumer lenders, and they need payment companies like EML or Makeda to provide them with issuing cards capability and so on. Now, they are making a lot of losses, and now we've seen Afterpay come out, well, Block, its parent, come out yesterday, Afterpay making $300 million loss in the last 6 months, Zip making losses, bad debts are rising, and with the interest rates, the cost of debt going up, they'll have further issues as well. So I think those businesses have been sold down, I guess probably correctly, and I think they will struggle. But there are other companies out there like EML and a few other ones that are profitable and should do quite well, and they should re-rate over time.
Okay, thanks for joining us, mate. Talk to you in a few months' time.
Thanks, Peter.
That's Ron Shamgar of Taman Asset Management. And today we want to focus on a sector that's really struggled in recent times, but has been historically a very good sector for investors, namely healthcare. Paul, let's just kick off with this table, which actually shows you how important the healthcare sector is and its performance of late.
Yeah, these are the 11 industry sectors on the ASX, Peter. You can see that healthcare makes up about just under 10% of the sector, 9.1%. So it's the third largest sector, but it's been doing it pretty tough this year. It's down 10.1% this calendar year, up in March, but so are all sectors. It was also did it pretty tough last year. Now, leading up to 2021, it's been one of the best performing sectors over the last decade, but certainly over the last 15 to 18 months, healthcare perhaps has come off the boil a little bit. And I guess part of the reason there, Peter, is because of rising bond rates. It's sort of been lumped into a bit with information technology.
Yeah. And so, Paul, on screen now we have one of the best performing companies, namely CSL, over the last 5 years. What do you think this chart tells anyone who's looking at CSL?
Well, look, it's been a great performing company over a number of decades. In fact, CSL shareholders effectively paid the equivalent of about 67 cents when they first bought their shares. They're now about 260. So that's a phenomenal performance. But I guess what it does tell you, Peter, is a couple of peaks. We had the big run up to 2019, where CSL became Australia's largest company. But since the recovery from COVID-19, it's by and large sort of kept pace, Peter, and been trading between about $255 and about $300. But I think you can see from that chart that typically, dips in CSL have been pretty well supported.
Yeah, and I guess it's also fair to point out that the coronavirus has meant that government regulations and interference haven't really helped the bottom line of CSL.
Yeah, certainly CSL's been taking on extra costs, and also one of its biggest businesses, Peter, of course, is in the production of blood plasma products. Well, you have to collect the blood plasma, and during the lockdowns and so forth, that made it a lot harder for CSL. So it's still able to grow its profits, but certainly the last couple of years have been harder for it. But the market's also been looking elsewhere for perhaps the next wave of growth stocks.
Yeah. Now, the next company on screen is ResMed. It too has been a good performer over the last 5 years.
Yeah, it wasn't that long ago, Peter, since it was under $10, and today it's sort of trading between about the low 30s and high 30s. So another great company, the leader in the sort of the sleep apnea market. But ResMed's done really well. Come off the boil a bit, but probably, again, priced to almost perfection, and in the environment of higher interest rates, some of our sort of global healthcare leaders have pulled back.
Okay, so what are the positives out there for the healthcare sector in general?
Well, I mentioned COVID, Peter, and you've got to remember that one of the impacts of COVID, of course, is it stopped a lot of elective surgery, and that reduced a lot of expenditure in the healthcare sector. So elective surgery has now recommenced, and so that's good for a number of our healthcare companies. They also, most of them had to put in a lot, as a lot of companies, they had to put in extra costs in terms of looking after, preventative measures and to do with COVID, and some of those cost pressures are easing. Longer term, Peter, we've still got some very favourable demographic trends. So, of course, an ageing population. And it's not just a question the population ages, but as you age, you actually need more healthcare services. So it actually increases demand. And that's certainly the case in the Western world. But of course, in the developing world, you've got a growing middle class, and they're availing themselves more and more to healthcare services. So the demography is certainly for it. It's a sector that there's a lot of investment in technology, and that of course means cost saving in terms of some of the treatments, but also as medical technologies get better, again demand improves because we're able to do more to keep people fitter and help prolong their lifespan. And then the other sort of positive is that particularly the Australian companies, look, they're well capitalised, they're global leaders, their balance sheets are strong, and they're well positioned to grow.
Yeah, and also these kinds of companies invariably do struggle after markets actually give way to cyclical type companies, but they do eventually make a comeback, don't they, Paul?
Yeah, and then look, there is some evidence to suggest that healthcare does better when the economy slows a bit. I don't think we're in that environment, Peter, but look, certainly, it's often considered to be a defensive sector. I think that's more characteristic of the US and the Australian healthcare sector, but that perhaps means that when people are looking for growth, they turn elsewhere. But I guess it's sort of one of those things, Peter, that we see the markets rotate through sectors. Currently, healthcare is just a little bit out of fashion. So that's one of the reasons it's been struggling as well.
Okay, let's go look at the negatives now.
Well, I mentioned, particularly in the Australian market, because of a lot of our healthcare companies are really focused on growth and do trade at pretty good multiples that reflect that sort of growth premium. Now, of course, we know that just as higher bond rates or higher bond yields have impacted technology companies, they've also impacted valuations for healthcare companies. So if bond rates go higher, that's potentially a negative for the sector. I mentioned about recovery from COVID. Well, look, that's in some cases has been perhaps a bit slower. And if we get more outbreaks or we get new variants that are discovered, then that potentially could impact the sector. And potentially there's some ongoing or permanent ongoing costs of just looking after patients better and looking after staff better to work in this market. COVID-19 variants, they could stymie elective surgery. And of course, the sector is particularly dependent on government expenditure. Now that's a real positive because governments across the world are spending more money on healthcare each year, but it also carries risk with that in terms of government regulation and sometimes the government sector wanting to interfere a little bit. And that, of course, could be an impact or have a negative impact on particular companies. And big pharma in the United States is one area that particularly is mentioned in terms of the risk of government regulation.
Okay, let's have a look at what the brokers are saying about some of the well-known Australian healthcare companies.
Well, in this table, Peter, we've probably got our 8 top healthcare companies listed roughly in terms of market size. CSL is the biggest by quite a long way. You can see in the third and the fourth column the forecast from the major brokers. So the average rise or fall is essentially a measure of how the consensus of the major brokers in terms of their price targets. So in the case of CSL, the brokers on consensus think that their target price is 19.5% higher than the current trading price of CSL. So they actually think there's quite a bit of upside in CSL. And one of the brokers, that's the fourth column, is actually thinks that the target price, his or her target price, is 26.5% away higher than the current ASX price. And then in the final column, you've got the number of brokers who are positive or negative. In the case of CSL, all of the 5 brokers are positive. That's effectively they've got a buy recommendation on the stock. Yeah. Overall, when you look at that, you see that the brokers are pretty positive on the individual companies, and positive on the sector as well, Peter. So I think there's some value there in a number of our terrific leading healthcare companies.
Yeah, Paul, and I think, listening to your story, if you put together the demographic trend that encourages people to use healthcare a lot more, then you throw in the fact that healthcare has been out of favour for at least a couple of years, the rotation effect ultimately tells me that if I invest today, I might have to wait a while, but eventually this sector will deliver because it's basically a sector that we have to use.
Yes, Peter. I mean, I think that we've got some great healthcare companies. We are a global leader in terms of some of these companies and the different parts of the market they participate in. I think there's got to be value there, Peter, and we know at some stage the market's going to come back to healthcare in a big way.
Exactly right. And that's the show for tonight. There's no show next Monday because it's a public holiday. So we'll look forward to seeing you next Thursday, but we'll have a bumper show where we'll try and pinpoint a lot more stocks that you'd be interested in considering for your portfolio. Thanks for joining us. I'm Peter Switzer.